Hey, this is Garrett Goggin with Gold Stock Analyst. Thanks for joining us again. Today we have Brett Heath, CEO of Metalla Royalties. Hey, Brett, thanks for coming on today.
Hey, Garrett, thanks for having me.
Um, we, have been covering a lot of the royalties, the larger guys, Franco, Royal, Silver Wheaton, Mosisco for, many years. This past issue, we just rolled out a special of some, the smaller upstarts, the upcoming guys in the industry. So in the past issue, we added Abitibi, EMX Royalties, Mavericks Royalties, and Brett's company, Metalla Royalties. And we've known Brett for a while. Brett had a company, High Stream Capital, previously, and he rolled it into Metalla Royalties this year. They've had a busy year. They've added some new royalties that I'm sure Brett would like to talk about. So, Brett, is all that accurate so far?
Yeah, so HighStream, we started this company actually, it was officially started September of 2016. So we're just over 2 years since inception now. Obviously there was a little bit of time before that is, putting these transactions together in the public markets take a bit of time. But September 16 was the official start date when HighStream came into the shell, and then we started Metalla.
Excellent. And so what what streams got carried over from High Stream into Metalla? What did you begin with?
Right. So HighStream was a royalty and streaming consultant business. So what I did at HighStream was I worked with private equity funds, other public companies, and I put together a lot of these transactions. And I did this through the bear market of 2012 to 2016. And understanding that it was not a very good time to start a new company when the market was, just in a terrible environment. As a new company, you need a little bit of at least stability, if not momentum. So when I saw the trend change in 2016, early 2016, we saw that big move. And instead of doing all these deals, giving them to other groups to retain all the value, I just decided to pull that into Metalla and start growing a new royalty and streaming company. And HighStream is basically the better part of a decade of not only relationships, but other different types of intel and basically a pipeline of transactions that has translated into kind of what you see as of today in Metalla.
So one of your contacts that you built up throughout the years was Frank Hannigan.
Yeah, Frank was he was a connection that I met through Mitch Krebs. He's the CEO of Core Mining, and I've been friends with Mitch for a while, and spoke to him even well before Metalla was still in concept phase. So what's different about Metalla, and why we've been able to quickly scale up a portfolio that's I'd say, at a rate probably a bit faster than kind of what the industry has been doing in regards to transactions, is our model. And that's really focusing on the secondary market. So most of our deals are derived from relationships that, we have going back a long time, and understanding where these assets are, and providing these holders a great platform to be able to monetize these things. If you look at the deal that we did with Core, just as an example, it was an all-paper deal, and it's worked out fantastic. It's worked out, amazing for the company in regards to their return. This was a group of assets that they had on their balance sheet that they were getting no value for.
So you paid $13 million in shares approximately, and then how many of them were in production? Endeavor was a stream of theirs, right?
Correct. So we acquired 4 assets from Core. In the Endeavor silver stream, which is today our largest producing asset. And then we also acquired the Joaquin royalty, which is going to be a Pan American silver development asset. It should be in production kind of January 2020 is the target on that one. And then we also acquired 2 smaller royalties, one on the Zaruma asset and one on an asset called Puchildiza in Chile, which is owned by a company called Regulus.
Okay. So in your mainstream endeavor, your revenue per year is about $6 million off Endeavor.
Yeah, so I mean, revenue is probably a bit higher. Our operating cash flow for this fiscal year should be kind of right around that number. There's a participation cost, as there often is for streams, right? Streams give you the right to purchase a certain amount of metal. For the Endeavor example, we get 100% of the silver out of the Endeavor mine. So that the Endeavor mine is a lead zinc mine. Actually primarily kind of zinc in regards to the revenue. And the silver is the byproduct. And so we get 100% of that, and we do have a participation cost. So this fiscal year guidance, what we've given to the market is about 9 to 12 million Canadian in revenue. And off that, we should get somewhere in the $6 million range of just straight operating cash flow. That's before kind of tax and G&A off that, and the other producing stream that we have today.
Right. That's where I got you at too. The net comes out to about $6 million a year. Now, that seems like a great deal. You paid $13 million and you're getting $6 million a year. How do you work such a good deal?
Right. So, what we found, or what is the reality of this market on producing assets, typically they're, even in this bad market, still incredibly expensive if it's on an asset that has a mine life for 10, 15, 20 years, right? The part in what attracted us to Endeavor is this was an asset that at the time only had a 2-year reserve. So we were able to get it at an exceptional price, but when we looked at it, this mine had a 3-year mine life for the last 10 plus years. And basically the way that, they run these things is kind of on a rolling 2-3 year plan. And when we did our diligence, we thought there was a, high probability of that being expanded, which was the case over the last year and a half since we've owned it. They've actually increased the reserves of the mine plan by almost double from when we originally bought it. And they also made an additional discovery at depth, which has the potential to make this asset go for much, much longer.
Who helped you do your diligence? Who's your geologist on staff or consultant?
Yeah, so we have a internal and external. We've got a group of technical consultants that we use for kind of each deal to oversee that process. What's important in regards to our process on how we do our diligence at the asset level is we engage basically past people, past employees, past directors. We go out and find people that have a long-standing history with that asset, which is very important because that is how you find not only all the diamonds in the rough, but all the skeletons and learn how to avoid and also learn how to pick up assets, at a good price. And we've been doing that on pretty much every single one of our deals that is material. And it's worked out fantastic as a way to really get a full understanding on the technical aspects of the mine.
Okay, excellent. So I guess you have Endeavor, the NGLM. Joaquin is going to be coming online 2019, 2020. And then Joaquin, that's going to feed the Metalla Espejo mill that Pan American owns, right? And then Joaquin, together with Cozy, are going to produce the feed, right?
Correct. So the Metalla Espejo mine is now basically only underground, and even the underground has a fairly short reserve that's left. So Pan American has a ton of money sunk in infrastructure costs down in Argentina, in a place of the world where there's actually a lot of gold and silver, and that's also in the same province where they have their big Navidad project. So they wanted to find a way. One of the best ways for major mining companies to really have a return on capital is utilize these costs. So That's exactly what happened. They picked up the Joaquin project, and then they picked up the Cozy project. And both of these are going to be the future growth for Pan American at this Manantial Espejo mine complex in the future.
Your latest news release was this past week, right, on Cozy?
Correct. So we just announced that we acquired the 1.5% royalty on Cozy, which consolidates the two. Now, what was great about Cozy is, we looked at it, it was actually, a bit different in nature, but also very similar to kind of how we looked at Endeavor. Meaning it's a short mine life on paper, but it's basically immediately in production. We think given the grades, the gold equivalent 52 grams per ton, we think there's, a high probability that we get more mine life out of Cozy, and that will lead us basically into Joaquin being in production. And any further upside, given that it was a short mine life, remember, this is capital that we're going to have back and going to be able to redeploy in probably 2 years or less.
So are you saying that the 1.5 you paid for Cozy has basically a 2-year payback?
Yeah.
Wow. Okay. And you're just you're betting. You've done your research and your geotechnical due diligence in order to see a longer mine life in order to get a higher return on capital, right?
That's how we look at these things, specifically on these assets that are in production by strong counterparties, where there's a short window for us to get our capital back. We're not so interested on paper, getting a substantial return. We want to lock up that royalty at today's price, which is going to, we think, drive big returns for shareholders in the future, because specifically on the underground type assets and the nature of these things, and when companies have already invested capital into these projects, what you can be sure of is that once they're in production, they will make sure that stays in production for as long as possible to be able to kind of utilize all those sunk costs, the upfront costs that are often involved with putting mines into production.
Right. They spend hundreds of millions of dollars, right, to get the mine in production. And then once they go through their initial ore in the initial deposit, then that mill sits idle. It's just, so to go find other feeds around the area to produce more production is just free money for those guys.
Exactly. And for Metalla, what we're looking for are not only assets that are in production, but also development assets, and development assets that we can say with a very high degree of confidence that these assets will get built in the next development cycle. If you look at a 1 million ounce deposit, and let's say it's owned by a junior, this junior may have a 50, 60, 70, 80 million market cap, yet they've got a great asset, but maybe the asset costs 200 million to put it in production, right? There's a huge amount of development risk because of the financing risk that's layered on top of that junior being able to raise that capital and successfully put it in production. So those are types of risks that we are trying to avoid, where we, for example, the previous transaction, which was the 2% on the Santa Gratudes property, which is Agnico Eagle, the big companies, they have the balance sheets, they have the personnel, they do their own internal technical work, and they build their own models, and they just allocate the capital and build the mine. So when we can acquire royalties on assets like that, we can have a much higher degree of confidence that these go into production specifically in this next cycle. And what we're focusing our portfolio around is not only production. Obviously, production is immediate production is great, and it's a little bit harder to find at a good price. And I think we've been able to do a good job of that so far. But great development assets that are owned by major mining companies, where as we get into this next bull cycle, we're going to have all that growth built in. That is going to supersize the returns for our shareholders. It's a little less attractive as of today because we're buying something that will cash flow a year or two out. But you got to remember, we're still very early in this next bull cycle in precious metals, right? If in some, that's still a debate. Some people say we're still in a bear cycle. I think we're in the early stages of this new bull cycle. And when the market turns and gold and silver prices rise, as a company, we don't want to be chasing that price. We don't want to be chasing higher and higher costs of acquisitions. We want to have all that growth built in. We want to lock in the gold and the silver, the future production of the gold and silver through these royalties and streams for the next 10, 15, 20 years at today's prices, because that's what's going to give the investors and the shareholders the most leverage.
Right, no doubt. You guys have done a good job regarding that. Talk about which assets are going to be giving you this upside. Like, what's the next leg in your portfolio? So it's San Gertrudis, right?
Yeah. So Cozy obviously is going to be in production, basically immediately, according to Pan American Silver's guidance. Joaquin should be about January 2020. Now we've got a few really important catalysts coming up here early in the year. First is we should get out in January guidance on an updated resource at the Garrison project. So this is Osisko Mining's number 2 project behind Windfall. Existing PEA had 2 million ounces of gold right off the highway, like ideal location down the road from a lot of Kirkland Lake's existing infrastructure. And this is an asset that we think will eventually get built, probably built by a major. And, our suspicion is that since Osisko acquired this property, they've put an additional 90,000 meters into the ground. So we think it's obviously going to be much higher than the 2 million ounce that was the old property, and we've got a 2% royalty on that. So that should come in January. In February, we should get an update on an updated resource estimate out of Agnico Eagle on the Santa Gertrudis property. And we think Agnico likely will continue to drill and work that property through the end of 2019. We do think that they'll probably have, the data and the confidence in order to kind of move that project or kind of make a decision to move that project towards production. That's just our opinion through kind of our diligence. It may take a little bit shorter, a little bit longer, but we definitely think it's a project that is just a very turnkey type of opportunity for Agnico to have more production coming online.
That sounds like you're going to have a busy first quarter 19 with your news coming January and February on 2 good assets. That is a lot of information. We appreciate it. We just wanted to, let you know that, we cover a lot of the royalties, right? The average royalty trades, Franco trades for like 20x operating cash flow. We've got you guys trading at 8x, only 8x operating cash flow because, you're a relative newcomer, probably, not a big brand name yet in the marketplace. But we've seen this before, some of the smaller guys, Premier Royalties, there's been a lot of others that have been taken out throughout the years where the larger guys will buy these lower valued royalty players. So have you noticed that also, your undervaluation in the marketplace?
Yeah, this is really the opportunity here for investors. If you think about the sector, all the companies that you just named, almost every single one of them were formed via spin out of a major. And as a consequence of that, they drove high valuations out of the gate. Metalla was started from scratch. We started with a shell. We did our first financing, was just a little over 2 million, and we've built it all the way up to a little over 80 million market cap as of today in the last 2 years. Now, because of that, and because we weren't a big spin out, because we didn't have that big name behind us, we're still below the radar. And, one of the reasons why, we're also doing this small financing right now is that we want to bring in some research, some coverage from some of the institutional platforms, because when we get above 100 million market cap, and we do have that coverage, we think that we're going to be at a tremendous value when basically investors kind of look at us across the market. And when we get of size, we also think that's going to be a major catalyst here for next year. And we do think that's probably coming in the next 6 months or so.
Right. Excellent. Yeah, we agree. Your valuation, about 80 mil market cap, and $7 million of operating cash flow a year puts you at a good valuation. And you've got solid properties. You've got solid streams and NSRs and solid properties run by experienced miners. So, it looks like a pretty good opportunity. So, we appreciate your time, Brett, and we'll speak to you soon.
Okay. Thanks, Gary.
Thanks.